We are back with another market update. It's been a while. I missed you. Did you miss me? Lots to talk about today. Is the market setting up for the classic Santa Claus rally? Lots to talk about today. Let's go. Hello, this is Michael Loftus with Wealth and Wisdom TV, where education is the key to a successful financial future. First time here, please do consider subscribing. We do all kinds of videos, market updates like you're seeing today. Got a list of a bunch of educational videos coming, podcast launching, all kinds of stuff. Also, we are now permitted to have comments. So if you have a question or comment, be nice. Please leave it below. So here we are, December the 1st. What's going on? Lots happening here recently. Had a nice surge into this quarter. A little bit of a bumpy ride the last week. But is the market setting up for that classic Santa Claus rally? Or could it be something else?
You sit on a throne of lies.
Now, we're going to go over this and much more. Let's go to the big board. All right, first time here, and since it's been a while, we go through market cycles. Going to discuss that, talk about our signals, short-term, long-term, etc. Do some sector spotlights, what's working, what's on our radar, what we're trimming, what keeps me up at night, some of those issues, and then we will end with a game plan, so hang in there. So first up, a big part of our process, and that's the key here, we have a definitive process. It's about the market cycles. Now, a year ago, November, we made the call to cycle 2. Growth accelerate, makes sense coming off some of the issues at that time, but inflation accelerates, and at that time, everyone thought we were crazy. Obviously, fast forward, that's all anybody's talking about. So we have solidly been in cycle 2 for some time. Third quarter this year, it looked like a cycle 3 situation, but it was really temporary. And then, like I said in the opening, we really took off as the quarter started until the last week or so. That being said, we are seeing some changes. Why do we see changes? Data. It's the underlying data. I use several sources for data to get the growth, to get the inflation. There's all kinds of factors that go in there. But right now, it looks like we're transitioning to this side of the board. It could be, and I say could be, cycle 1, which is kind of a Goldilocks scenario, which would be great. Everything works in cycle 1. Growth accelerates, inflation decelerates. We're going to talk about that. Or it could be a narrow cycle 4. That being said, I think that's what we see next year going into Q2 of 22. Again, we are seeing that movement. We are starting to make some changes with our models. We'll discuss that. So now let's go to the big charts. All right, so first up in the signals, we go long-term, okay? We look at long-term, 3 years or less. Obviously, you can see this trend line, pretty positive. You know, at the end of last month, it looked a little interesting, obviously, but overall, and as you can see, definitely a positive signal on the long-term view. All right, next up is a weekly chart. This is where I look at our midterm trend, which is 3 months or less. Now, clearly, still very much positive, no issue there. At the top, that's relative strength. I'll talk about that more in the next one. Still above a certain threshold I look for. Is there anything concerning here? Because it is positive. Anything concerning, the blue line is your 200-day moving average. And you can go back several years and see, okay, we've been stretched sometimes, 17, 20, 16. We're at 33% above the 200-day moving average. That does concern me a little bit, okay? But again, still positive. So next up, we have the daily chart. So what do we look at on the short term? Short term is 3 weeks or less. Okay, that's what we call the trade. So you have trade trend and then the long term. What's going on here? like I said, we had a nice little pop here in this quarter, and then it got sloppy, okay? Various reasons. We'll talk about that in a second. Anything else I see here? Well, we never got the truly oversold. So at the top of the chart, that's called relative strength. When we go above 70, that's overbought. You can see it here. Not surprising to have a consolidation like we've been having. We never really got to 30, which would be completely oversold, okay? The other big thing I look at in the chart is down here, is the volatility index. 15 and below, all things are good, all right? Market volatility, no problem. When you go 15 to 20, still pretty good. Opportunity, 20 to 25 gets choppy. Above 25, whew, be careful, okay? So that's our trend. And as has happened all along, we've gotten above that 25 and it failed. We call that non-trending, non-episodic, okay? So it's not consistent. It failed there, which gives me belief we're going to continue to go higher, okay? So let's take a look at some other things here. Next up, short term, not a surprise with all this noise and volatility. This is stocks above your 50-day moving average. So a stock above its 50-day moving average. We really kind of peaked out there. We've had, if you go back at the beginning of the year, we're in the 80s, got a little bit lower, came back up to 75, and then we kind of had a dive here where we're down to about 50% of companies above. This updates at the end of the day. So this is something I will be watching going forward to make sure that, again, I feel we're going to go higher here, okay? So this is something I'm looking at right now. On the overall market, NYSE, okay, that was the S&P. Kind of surprising for the first time in a long time. This is new highs minus new lows. Companies hitting their new highs minus new lows. We went negative, right? Big surge to the downside, having a little nice counter trend move today as we anticipated, okay? So at this point, it really continues to be a buy the dip type opportunity, kind of what we did this week on some things, and we'll discuss that in a second. We've talked about the S&P, the NYSE, the beast, right? The driver is the NASDAQ, tech, okay? What this shows you is it shows the NASDAQ relative to, in performance, the S&P. Clearly, the NASDAQ outperforms, but most importantly, on this chart, we broke a long-term trend, and tech is going to continue to be the driver. That's really where we're focusing on here as we head into this cycle 1-2, is adding and continue to add more tech when opportunity presents itself. So, anything else that concerns me? I show this all the time. So PE, price earnings. We again hit a 40 PE, which is pretty crazy. And it tells you how overbought this market is. Okay, so on this chart, I've got red, blue. I didn't do green. Okay, red is considered overbought at 20 PE. 15 is your long-term average. Green would be sold at a 10. I didn't put it in there because it's so much lower, but if we were to go back to a 20 PE, that's roughly a 30% correction. And on the long-term average, it'd be 48%. I'm not calling that today. I do think we're way overbought. A lot of articles, a lot of people calling that. I don't see it today because, one, the Fed's still very much involved in the market, and we do see some growth, okay, and things improving underneath. So, next up, sector spotlight. All right, next up is we get to our sector spotlight and also the underlying market and with our cycles, right? There's two things we look at. The first thing is the US dollar, right? US dollar was pretty high. As we went into cycle 2, it went lower, but as you can see, we've had this breakout. Now, that does affect a lot of things. I'll explain that in a second. So this is something that we're watching. Probably the biggest thing that it's going to affect is down here, which is commodities, right? This is the commodity index, which is soared over last year. Everyone's top complaint, of course, is oil and whatnot that has gone up quite a bit. So with the US dollar, going higher, that should help move commodities come down a little bit. I still think we do have inflation. We'll talk about that. But the dollar, I think we're here. I don't see much more of a breakout, but it's going to stay in this range as we go forward. So the next thing is the Treasury, okay? So in the Treasury market, when you go up in cycle 2, okay, what happens? Well, yield goes up. Well, if yield goes up, prices go down. So we've been out of Treasury since last November. All of a sudden, we have had this counter trend move here, okay? It's come up a little bit, not too much. Keep in mind, we're down as 0.65% just a year ago, and today we're at 1.4. Now, when we look at the cycle change, I anticipate us to stay in this range, which means not much. Not enough reason to start adding treasuries. Also, a reason, so when treasury yields are going up, who does well? Banks, insurance companies. We've removed some of those because we don't think the treasury is going to move much over the short term. When we hit cycle 4, that's when you see the treasury going down, and that's your opportunity. So those are two key components. From there, if in fact US dollar goes up, who benefits? Emerging markets, okay? So the first one is, this is a ETF for China. As you can see over here, it peaked. We were in China, thankfully got out of China. You've had a full-blown correction here, 20%, but guess what, folks? It's coming back. Why? Because China has been in cycle 3, stagflation. Worst cycle to be in. Stagflation is the 70s, right? Is what you look at. But we're starting to see a series of higher lows on it. Today we have a nice move on the upside. Here it shows you we're also seeing, most importantly, data-driven, that data is getting better. This shows the PMI is up November over October. We're seeing some other things. So China is definitively on my radar, not in our portfolio yet. And if you're going to be in China, the biggest portion of emerging markets is China. So same thing here, right? We've gone straight down. We think we've bottomed here, okay? It's up nicely today as a whole, but it's not just China. There's some other countries that we look at that we might add individually before we add China. Not discussing that today, but this is something we're looking at as we go forward. The next thing is, which has been a recent, if we're heading towards cycle 1, and it's Goldilocks, consumer discretion. Okay, you've got consumer staples, right? Your staples you use every day. That does very well in cycle 3, 4, but in cycle 1, consumer discretion, people are going to be spending money. So we'd like that as we go forward. And the other thing we're worried about, and we talked about this in the opening, commodities, okay? So here's oil. What's going on with oil? Well, we've had a big move in the last week. As you can see, right? We kind of went up, topped off, and then boom. Now, we're having a nice counter trend move today, but there's something here that has really got me concerned, okay? OVX, which is down here, which is the volatility of oil, has spiked to 72. So for now, okay, we're going to talk about inflation in our next session, but when I look at this, okay, I really have concerns here. So on a day like today, I might start trimming. Oil's been my #1 commodity over the last year. We've owned lumber and copper and natural gas, which broke trend yesterday, by the way. So we're seeing some breakdowns in commodities overall. Has me concerned, but that volatility spike really has me concerned. And in cycle 1, I think we're going to have some better opportunities as we go forward. Bottom line, have had a great run with oil in the last year, but with volatility that high makes me very concerned. We'll probably start trimming, not fully sell out, but start trimming as we go forward, and let's see what happens with volatility index. Next up, what keeps me up at night? All right, favorite section, what keeps me up at night, right? Actually, not that much this time, but this. There's so much noise in the market right now. Oh, right? Everywhere you look, political, geopolitical, right? Stuff happening overseas, all kinds of medical issues. So much noise, you got to put it aside. Focus on the data, right? Focus on the process. Put that aside. So let's go through some of that right now, just a couple points. So ironically, okay, Powell's pivot on inflation. So he's taking out the word transitory. Seriously? We've been saying this for a year, right? We started a year ago in this, and it's been ridiculous. Now, the problem is, as the Fed has said, they're taking out the word transitory. Guess what, folks? We're now going the other direction. Here's CPI and estimates. Now, keep in mind, we just peaked. That's the key here. We feel that we've peaked with CPI inflation. Yes, it's an ugly number. It's actually higher than that. Is anybody not paying more than 6%, 10% with a lot of items today? But this is how the Fed registers this, so you can kind of see where we've gone. But at the end of the day, yes, it'll be sticky a little bit, but it's going to go down. So from our standpoint, when we look at the data, we're looking at that rate of change, and it will be going down, okay? So that's something we're very mindful of when it comes to the cycles and our portfolios. So next up, something we haven't talked about in a long while is Treasury spreads, okay? You take your 10-year Treasury minus your 2-year, and that's called the yield spread. And what it does, historically, has been able to predict recessions. The red are the recessions. And you go back, even before our big situation a couple years ago, the medical issue is a simple fact that the yield curve was telling us a recession was coming. Now, obviously, the Fed printed all this money, got us out of it. In fact, the shortest recession in history at 3 months. But if you zoom in here, we've spiked and you see us coming down. Cause for concern? Absolutely not. We're 0.91. We're just 0.98 a couple of days ago. Yeah, it's going down, but you got a long way. Below zero on the yield curve is when it indicates a recession. Another thing I'm following closely is high yields. Okay, they have something called high yield spreads. I'm not showing that. I'm just showing you high yields in general. High yields have gone down to an all-time low. Okay, and even high yields, meaning you're getting a higher yield, but you're buying something that has a lot more risk. That's what high yield is. Okay, but even with high yields down in the fours, with inflation, you're still seeing a negative number. Now, when you look at the long-term chart, it doesn't look that bad. But again, we zoom in, and we have really had a push to the upside, right? Today, we're looking at, I'm trying to get a number here, about 4.7% on the high yield. I look for that as an indicator of bad things to come because it's telling you either companies are starting to default or the street, Wall Street investors are not willing to pay for that risk at a lower yield, okay? Meaning things will slowly get worse. So that's something I continue to watch. Not a concern today because quite frankly, it'll be in the 8 range when we really get concerned. Next up, let's talk about game plan going forward. All right, as a reminder, make sure you hit that like, subscribe, comment below if you have questions, etc. So our game plan going forward, pretty clear, I think, transitioning purchases to new cycle. All right, we've talked about that, showed you a couple. Keep in mind, I don't show everything. That's for clients only. Opportunities, I always say, sell on green. So today, when I see oil green, that's a great time to trim. Buy on red, okay? Be smart with those purchases. The other thing, besides all that, there's some themes I look at. I think when you look at the EV space and, all these cars going electric, the lithium space is interesting. Infrastructure, I don't care about politics. With that bill going in place, there's certain sectors, certain companies that will benefit from that. So I've looked at some of those. Supply chain, right? We added some supply chain names about 5-6 weeks ago that kind of got beat on the last earnings. Good quality companies. As the supply chain gets better, and it is getting better, okay, there are some opportunities. We still look for that volume and volatility as we go forward. Make sure we're being smart. Volatility is a big one for us. And most importantly, make sure you follow us for updates, Twitter, Facebook, all that kind of stuff, where we regularly post. Thanks for watching. Michael Loftus, Wealth and Wisdom TV.